AI predicts daily SPX range better than formulas. Live backtest results. I have been using the same expected daily range formula for over a decade. It is battle tested, it is grounded in historical volatility math, and it has been a core input for every Iron Condor I have placed. And an LSTM neural network just beat it. 92% accuracy versus 87% accuracy across a 60-day live backtest. That 5-point gap does not sound dramatic. When I show you what it translates to in actual trade outcomes, you will understand why it matters. Today we are going to walk through the backtest results, including 5 days of live data that you can replicate yourself. Explain in plain English how the LSTM model actually works, and talk honestly about what AI can and cannot do for systematic options traders. The accuracy problem. Let us start with why range prediction accuracy matters so much for Iron Condor trading specifically. When you place an Iron Condor, you are selling premium on both sides of the market and betting that the underlying stays within a defined range before expiration. The two critical decisions are where to set your short strikes, the boundaries of the range you are betting on, and how wide to make the spread. Both of those decisions are direct functions of your expected daily range estimate. Here is the cost of getting it wrong. If you underestimate the expected range and place your strikes too close to the current price, you collect more premium, but you are breached more often. If you overestimate and place strikes too far out, you are safer, but you collect so little premium that the trade barely justifies the capital commitment. Strike selection accounts for approximately 70% of Iron Condor profitability. The entry timing, the management, the exit, all of that matters, but it is downstream of where you put those strikes. A 10% accuracy improvement in range prediction is not a nice statistical upgrade. It is a structural change in how often your strikes are positioned correctly. The EDR formula, expected daily range, derived from the VIX and adjusted for historical volatility, gives you a solid baseline. It is mathematically grounded, and it works well in normal volatility regimes. Where it consistently underperforms is in transition periods, when the market is shifting from low to high volatility, when a trend is developing, when sentiment is moving faster than the raw volatility numbers have caught up to. Those are exactly the conditions where breaches happen, and those are exactly the conditions where the LSTM model outperforms. How LSTM actually works. LSTM stands for long short-term memory. It is a type of neural network specifically designed for sequential data, data where the order of inputs matters, not just their values. Financial markets are almost definitionally sequential. What happened yesterday and the day before it and the week before that all contribute to what happens today. Traditional formulas like EDR treat each day as relatively independent. They look at current volatility levels, current price, historical patterns, and produce a range estimate based on those inputs. That is appropriate for stable markets. The LSTM model treats each day as the latest element in a sequence. It remembers, structurally, in its architecture, what the recent sequence of market conditions looked like, and it uses that memory to inform its current prediction. The model Russell developed for VixShield uses 30 input variables. These include the VIX at multiple time horizons, historical volatility across multiple look-back windows, intraday momentum indicators, options market sentiment derived from put-call ratios and skew, and overnight futures movement. Those 30 variables feed into 3 hidden layers of the neural network. Each layer identifies increasingly abstract patterns in the data. The first layer might identify raw correlations. The second layer might identify regime patterns. The third layer might identify the relationship between regime transitions and range expansion. The sequence memory architecture means the model does not just look at today's inputs. It looks at today's inputs in the context of the last several weeks of input sequences. A spike in implied volatility that follows 2 weeks of calm is processed differently than the same spike that follows 2 weeks of elevated volatility, because the model has learned that those two contexts produce different outcomes. That is the plain English version of what the model does. It learns from sequences, not just from individual data points, and sequences are where trend days and volatility regime transitions, the events most likely to cause Iron Condor breaches, live. 5-day live comparison, April 7 to 11, 2026. Here are the actual results from the week of April 7th through April 11th, 2026. 5 days of live data with both the EDR formula output and the AI model prediction compared against the actual SPX daily range. Monday, April 7th. The EDR formula predicted a range of 42 points. The AI model predicted 51 points. Actual range, 49 points. The EDR miss, 7 points on the downside, meaning strikes placed at the EDR boundary would have been uncomfortably close. The AI model, 2 points from accurate. Tuesday, April 8th. EDR, 38 points. AI, 44 points. Actual, 36 points. Both models were slightly high, a normal day where conservative strike placement was rewarded. No meaningful difference between the two. Wednesday, April 9th. EDR, 39 points. AI, 47 points. Actual, 52 points. This was the day that illustrates the core difference. Wednesday was a trend day, a developing momentum move that the raw volatility inputs did not fully capture until after the fact. The AI model, reading the sequence context from the prior week's data, identified that conditions were setting up for above average range expansion. The EDR formula, working from current volatility data, did not. EDR was 13 points below actual. AI was 5 points below actual. Thursday, April 10th. EDR, 41 points. AI, 48 points. Actual, 45 points. AI, 3 points from accurate. EDR, 4 points below actual. A minor difference. Both performed adequately. Friday, April 11th, EDR, 37 points. AI, 41 points. Actual, 40 points. AI, 1 point from accurate. EDR, 3 points below actual. Over 5 days, the AI model was within acceptable accuracy on all 5. The EDR formula had one significant miss, Wednesday, that would have put strikes uncomfortably close to the actual range in a live trading scenario. That single miss in a week is representative of the larger pattern in the 60-day backtest. The AI model catches the trend day and regime transition events that the formula misses and performs approximately equivalently on normal days. Converting accuracy to dollars. A 10% accuracy improvement sounds statistical. Here is what it looks like in a live account. If you place approximately 60 Iron Condors per year, roughly 5 per month, and a 10% accuracy improvement translates to 6 additional winning trades annually, trades that would have breached your strikes with the formula but stay within range with the AI prediction. The math is direct. At an average premium of $300 per Iron Condor, 6 additional winners equals $1,800 in additional annual profit, before commissions, before adjustments, at a conservative premium estimate. At larger position sizes, the math scales proportionally. 10 contracts per trade, 6 additional winners, $18,000 annually. The accuracy improvement is not about feeling better about your predictions. It is about a quantifiable, compounding improvement in trade outcomes. The 60-day backtest showed 92% accuracy for the AI model versus 87% for the EDR formula. The 5-point gap held consistently across different volatility regimes within the backtest period. low volatility stretches, the January consolidation, and the April acceleration. Two paths forward. If what you have heard so far is interesting to you, there are two paths depending on your technical background and how you want to engage with this. Path 1. VixShield AI signals, launching May 2026. The LSTM model described in this video will be integrated into VixShield as a daily signal alongside the existing EDR output. You will get both predictions each morning, the formula baseline, and the AI range estimate, along with the ALVH tracking and regime alerts that are already part of the daily signal stack. You do not need to understand how the model works to use it. You need to understand what it is telling you about your strike selection, and you need to make the final judgment call yourself. Path 2. Build your own in Python. If you have a technical background and want to build your own range prediction model, the architecture is accessible. TensorFlow and Keras provide the LSTM implementation. The 30 input variables are all derivable from public data sources. VIX, historical price data, futures, put-call ratios. The genuine challenge is not the model architecture, it is the data pipeline, cleaning and normalizing 30 variables across multiple time horizons, ensuring the sequence inputs are structured correctly, managing the training validation split to avoid overfitting to historical data. Russell's book, AI-Driven Options Mastery, walks through the full technical implementation, the input variable selection, the model architecture choices, the training process, and critically, how to evaluate whether your model is actually learning patterns or just overfitting to noise. That last part, distinguishing genuine predictive signal from statistical noise, is where most DIY model builders go wrong. Ethical AI, the assistant, not the decision maker. Before we go further, there is something that needs to be said clearly about AI in trading contexts. Do not outsource your judgment to a black box. This is not a disclaimer. It is a structural principle of how to use predictive models without being destroyed by them. Any model, LSTM, transformer, random forest, anything, is a statistical summary of historical patterns. It has no knowledge of tomorrow. It cannot account for events that have not happened before, and when conditions move genuinely outside its training distribution, a black swan event, a policy surprise, a structural market change, the model's predictions become not just inaccurate, but actively misleading. The correct way to use an AI range prediction is as one input among several, a second opinion from a system that processes pattern recognition differently than your formula does. When the AI model and your formula agree, that convergence is meaningful signal. When they diverge significantly, that divergence is also meaningful. It is telling you that something in the current market context is ambiguous enough that two different analytical frameworks are reading it differently. In both cases, you make the final call. The AI model does not place trades. It does not know your account size, your risk tolerance, your current hedge structure, or your exit constraints. All of that judgment remains yours. AI as an assistant is enormously valuable. AI as a decision maker is a route to catastrophic loss when the market does something the training data never showed it. What is coming? 2027 and beyond. Looking further ahead, the architecture of AI in trading is moving towards something more significant than improved range prediction. By 2027 and 2028, the most likely development in systematic options trading is what is beginning to be called autonomous agents. AI systems that do not just predict ranges, but monitor positions, calculate hedge ratios, identify adjustment triggers, and in some implementations, execute trades within predefined parameters. This is not science fiction. The technical components, multivariable monitoring, rule-based execution, real-time options data integration are all available today. What is being assembled is the orchestration layer that connects them. For systematic options traders, this represents both an opportunity and a risk. The opportunity is that the mechanical work of monitoring and adjustment, the work that requires constant attention during high volatility periods, could be largely automated within parameters the trader sets in advance. The risk is that traders who do not understand the underlying system, who use autonomous agents,